Dell reporting earnings after the close of trading today. The conference call just getting underway. Our own Junie Hyman is here to give us a look at what's going on. Numbers, reaction, operating margins, all pretty good.
Everything looked pretty good except for the revenue. That was the one area of a little bit of lightness, $15 billion versus the $15.4 billion that analysts were looking for. But really the focus was on margins and on earnings. There have been some concerns that component prices, which have remained relatively low over the past year, are starting to go up, and then that's going to start to compress margins. It didn't really happen in the quarter. Margins were 23.4% on a gross basis, adjusted basis. 20.5% is what analysts were looking for. Earnings per share coming in at 54 cents. That's 12 cents better than estimated. So it looks like that Dell is benefiting from businesses, from corporations, not from people like you and me. We're not buying computers, apparently.
It did indeed. What did they give you any guidance in terms of costs? Are they able to maintain cost control?
It sounds like they did. I mean, the consumer side is still weak, down 7.5% in terms of the revenue. In terms of what's going to happen with costs and earnings going forward, the company pretty much stayed the course in terms of its forecast for the full year, and it's in line with what most people have been expecting. So even though this quarter did better, it seems like if they're not moving the needle much on the forecast for the year, that they're still expecting perhaps, some bumps in the road.
Makes it difficult for investors because it's a contrast to what we heard from Hewlett-Packard earlier today and in that email statement last night,
yes,
that they're having difficulties, and they say that it's going to be a challenging quarter in the future. And indeed, they mentioned headcount specifically.
Well, there are a couple of things going on here. First of all, Dell is pretty heavily dependent on enterprise spending. Again, big corporations. HP definitely has that side of the business too, but what I'm hearing from analysts is that in the services side of the business, consulting services, IT outsourcing, that HP hasn't perhaps made the same sorts of investments that Dell has made or some of the other big tech companies have made. And so now they're taking a step back, HP is, and saying, we really need to invest a little bit more in that business. That's going to crimp margins in the near term. We need to get that business up to speed. They're also mixing up the management of that particular business and trying to get that back to health, essentially. Both of the companies are suffering from weak consumer demand. It's really what they're going to do on the enterprise side that's going to differentiate them.
All right, well, don't go away, because I want to stay with you in this story, and we have more on the Dell numbers and what it means for the personal computer industry and investors. We have Ashok Kumar. He is a senior analyst at Rodman Renshaw. He joins us via telephone. He's got a market outperform rating on the shares of Dell. Ashok, good to have you with us here on Bloomberg. What do you make of Dell's results? Particularly, let's start with those operating margins.
Yes, I think the company is benefiting, from a benign pricing environment within the PC segment, and also strategic buys and structural changes to the supply chain, so which should inflate the profitability in a near term. The bigger picture is, the company is also positioning itself away from being a point product company into more of a solutions-oriented company, and so that in turn reduces the volatility of the margins to the mix shift towards the higher-end server storage and services.
And Ashok, do you think that they are doing that pretty successfully in terms of the diversification? Where are they in terms of the potential growth in that particular business?
Yeah, that's a good point. I think we do expect the company's bottom line to grow at a faster pace in revenues. And part of the reason is the company has divested or pruned some of the less strategic and lower margin business. For example, in the storage segment, the company will increasingly focus on their acquisition compelling at the expense of EMC's revenues, which should drive more bottom line results, for the company. So I think so the net is, and again, more of a solutions and less of a point, product company, which should benefit, profitability longer term.
Ashok, what about costs?
Yes, the company has, benefited, from a strategic realignment of the supply chain. And so I think strategic buys as some longer-term components has benefited the margins in light of a benign pricing environment. Again, these trends, could reverse given that we are witnessing a slower growth in a PC market. The more recent IDC numbers indicate that for the full year, PC unit growth will be in the 3 to 4% range. But as you suggested, with the company's higher exposure, unlike Hewlett-Packard, to more of the small business and enterprise side of the market, they're less exposed on the downside to weaker consumer spends in the developed markets, North America and Western Europe.
On the pricing side, though, and on the margin side, how sustainable is that? You mentioned that there is a question as to how long this can last. I mean, what do you think? Are we going to continue to see this type of margin growth in the second half of the year?
Yeah, I think that's a good point. I think the bear case is, once I think we'll start to see component prices firm and we'll start to see prices resume its normal decline. In other words, the ASP and the margin tailwind the company is experiencing near term is transitory in nature, but I think that remains to be seen. So I think it's prudent to expect some kind of margin pressure, but I'm not sure if the entire margin improvement that we have seen at Dell will completely reverse.
Ashok, the company reported sales that were $400 million below Wall Street's average analyst estimate. What's the problem?
I think, again, that was not a surprise. I think the reason why Dell stock has outperformed, Hewlett-Packard, for example, since the last earnings release, Dell stock is up 20%, versus HP stock is down 15%. And part of the tailwind is, again, improving profitability as the company right-sizes into some of the more profitable segments. I think the industry or the investors recognize that the PC market or the legacy core business is minimal top-line growth with no bottom-line contribution. So the company is doing the right steps in terms of repositioning towards a higher margin enterprise solution and services.
Ashok, even as the company does reposition, the consumer PC business still makes up what, in the teens, a fifth of the company's revenue or so. Does Dell need to get a little sexier on that side and have some better consumer PC offerings?
Yes, I think that's the same conundrum faces Hewlett-Packard. I think we are beginning to see the consumerization of IT. So I think the company does not have a runaway product. So I think more blocking and tackling. I'm not sure there is a magic bullet for Dell in that market. But I think they're going back to the basics. In other words, the annuity business is still the enterprise small business segment. I think that's where Dell will likely find its long-term success.
Ashok, time for one more question. The shares are up 5% in after-hours trading, $16.72. What are the shares of Dell worth?
Yeah, that's a good point. Even at these levels, it's trading at about 9 times earnings, 6 times X cash. I think the stock continues to be undervalued, and it does not fully reflect even a partial turnaround under this transformation the company is going through. So I think for a patient investor, I think there's more upside here.
All right, I want to thank you very much. Ashok Kumar joining us from Rodman and Renshaw, and also Julie Hyman from our markets desk commenting on the report from Dell.